Hello, Winning Investor Nation. Welcome to Monday Market Insights right here on the Winning Investor Daily YouTube channel. Hello, Ian. Good morning. How are you this morning?
I'm good, Amber. Welcome to the fourth quarter.
Oh,
October is here, and that means we have 3 months left of the year.
that's it. And then 2022 will be in the history books.
Mhm.
So, Ian, I'd like to kick it off as an economic overview. Just
Mhm.
so we can get a good footing on where we are right now. The Fed will likely continue to press on in its interest rate hikes. U.S. economic data actually shows inflation is still running hot in several key U.S. economic indicators. And also, Ian, the annual 2021 GDP revisions are out, and they actually show that the economy was more overheated and robust than previously thought. While August's core personal consumption expenditures, that price index is called the Pce Deflator. Well, it's an
Mhm.
index, it's very watched closely by the Fed, and it actually measures the prices that people living in the US and those buying on their behalf, what they pay for goods and services, excluding food and energy. Well, that index actually revealed underlying inflation running double the Fed's price target. And lastly, the labor market, we have to look at that. Job layoffs are still relatively low as demand for workers actually outpaces supply. That continues.
Mhm.
So, with workers still able to find work right now in the event of a layoff, coupled with falling productivity, we'll likely see just the continued upward pressure on wages for the time being, which is another indicator that the Fed watches, which means
Yeah.
more rate hikes ahead are likely to try and cool things down. So what do you think,
Yeah.
Ian?
That's one of the most important things that Powell is watching right now. So it's this idea that there's 2-to-1 job openings for people looking
Mhm.
for work. And because there's so many available jobs opening, the companies have to increase their wages to attract talent, right? So that's why you're getting this labor inflation. So we actually want to see the number of job openings come down. Ironically, we want to see bad news in the economy in order to see good news in the stock market. We're in one of these environments, and it's been running at 2-to-1. So hopefully, we see some less job openings, and you're seeing major companies like Facebook last week, which is now called Meta, announced layoffs, and other tech companies have done so as well. So I do think you're going to start to see, if not in this number, but then in the next month or so, the number of job openings start to come down. And then, of course, this on Friday we have the big number, right?
Oh, yes, the jobs report number will be coming out. I have some foresight on that number. We're
Mhm.
actually for the Fed's job number, which I'll put up on the screen for September. Actually, we'll post at 8:30 a.m. Eastern time. And survey estimates that the economy will add fewer jobs with the unemployment rate remaining unchanged at 3.7%.
Hmm. Yeah, it sounds like the Fed wants to get to about 5% unemployment in order to start to bring inflation down. So, we could have a ways to go, but they've already raised rates. We know that. Credit is harder to come by in the United States. A
Mhm.
mortgage right now is 6.5 to 7%. So we're going to start to see the economy slow down, even though you're not seeing it in this number. And also, we spoke about this before, raising interest rates, the Fed policy takes months in order to start to filter through the economy. It's not going to happen automatically. And as we saw, you saw a huge home sales number last month.
Mhm.
And one of the reasons why is because when people buy homes, they lock in their rate a couple months ahead of the close.
Right.
And I think in the summertime, you also had this scenario where sellers were worried about the housing market in the future. So they started to reduce their prices, and buyers also were worried about higher rates. So they started buying houses as fast as they could before rates went up. And I think a lot of that went into the data. But so, I believe you're going to start to see home prices come down after this, home sales come down. And really, that's the largest pillar of growth in the economy. And that should go pretty far to start slowing things down and cooling inflation. And we've already seen it in commodities, obviously, which we've detailed.
Most definitely, Ian. And our viewers may wonder, so what does this mean for our investments? What does this mean for us, for our model, for our portfolio? And Ian, just like I mentioned, the Fed will likely continue to press on with these rate hikes. We all agree on that. And of course, everything is still running hot where economic data is concerned. But here's the thing. The situation will get a bit worse before it gets much, much better, which means that investment strategies need to be geared toward current type events that we're experiencing now. Should we dare we say bearish type events? That has to be considered. And I am actually happy to report today that Ian and I, along with the rest of the research team here at Winning Investor Daily, have developed a strategy for this time, this very time we're living through. This is a strategy that works great in a bear market. It works so great that we're actually holding a special event on October 20th called Bear Market Fortunes. You actually discover how to pinpoint stocks positioned to at least double over the next 12 months. And you'll be hearing more about this strategy in the coming weeks, but I thought I'd go ahead and just mention it in our video today just to give it a little highlight.
Just a little bit of a tease.
A little tease. So I think you're going to like it, really like it, everyone. I actually am really all for it. Been involved with the research that Ian has really just had a brainchild over. So it's good for even, yes, these market conditions. So please be sure, if you haven't done so already, to sign up for Winning Investor Daily by clicking the link in the description section of this video below, or in the email that accompanies this video that you'll receive. And all the details about the upcoming Bear Market Fortunes event will be available in those emails, and you'll be the first to know.
Awesome. So thank you, Amber.
You're welcome. So Ian, you actually have been quite active on our Slack channel and posting such great nuggets of information. I thought we should maybe post some of that so everyone else can see what we talk about behind the scenes. And one was just something you posted in the Winning Investor Daily Slack channel this morning. Do you want to shed some more light on this particular graphic?
Sure. So this comes from actually Hirsch Holdings, Inc. And it's just a bit of research that talks about, how does the market perform in the fourth quarter post World War II after having a down 3 quarters. And what's really remarkable about this is they actually looked at also when there's midterms. Okay. So right now we're in the middle of an election season. Obviously you've got the election coming up in November. And if you look at the line shaded in blue, you'll see that 88.9% of the time during a midterm election, you have a positive fourth quarter after a down first 3 quarters. And obviously, we're in a different scenario than we were in all these prior scenarios, but this just gives me a lot of hope that we could see a pretty significant rally in the fourth quarter, specifically because everyone is leaning bearish. The whole world, every investor, whether institutional investor, they're trying to raise more cash. They're worried about what the Fed is going to do. And a lot of that is already discounted in the markets. And something we also talked about last week was that, the tech company Micron came out and warned, and the stock went up. And this is how bear market ends, when you start to see companies go up on bad news. And I think we're at the part of the cycle where it means that a lot of the bad news has been discounted. Now, Tesla also warned over the weekend. They said that the inventories, that the sales were going to be slower than expected. So the stock is down this morning as we're recording this, but I anticipate that at some point buyers are going to come in and say, okay, this stock has been hit hard enough. We've seen Tesla and Apple really come in the last couple of weeks, which means that these were sort of the bellwethers, the leaders, where a lot of investors, especially in tech, were hiding. And, the war usually ends when you take out those generals, right? So it's like there's no place left to hide. Everyone has been pretty much cleaned out. And then you can sort of start this new bull market. So, I think that at the end of the third quarter, just going back to what I was talking about, a lot of institutional managers were trying to get to cash so that they can report to their investors that, hey, look, we've got this much cash on our balance sheet. We don't own these stocks. And so they were selling them indiscriminately. And the fourth quarter starts and the market is pretty well discounted from where it was because of all the selling. And you see historically, the fourth quarter actually turns out to be pretty good when you have the first 3 quarters being down. So, the key here really is going to be, as long as interest rates can kind of level off and not continue to go higher in the US, and I'm talking about bond rates, 2-year bond and the 10-year bond specifically, I think we setting ourselves up for a nice fourth quarter here.
Okay, that's great news. We love silver linings, anything that gives us glimmers of hope there. So good job on that information, Ian. And just turning to the economic calendar week ahead, so everyone's on the same page, there will actually be 6 major US economic releases this week. On Tuesday at 10 a.m. Eastern Time, durable goods orders, factory orders, and job openings will post. While durable good orders will likely be unchanged from its prior reading, factory orders may see an improvement, and jolts may signal a cool down in labor demand, in particular, of course, in the housing market, as mortgage rates, as Ian just mentioned earlier,
The jolt is that job openings number that we were talking about.
Exactly. And these interest rates.
It's not a kind of overly caffeinated cola. I don't know if you ever had any of that Jolt cola, Amber. Does that ring a bell? No? Oh.
No, but I'm sure it's a pick-me-up.
Yeah. It had like double the caffeine as Coca-Cola and double the sugar, but I think they banned it. But so that's good for everyone.
Yeah, it's good for exactly. And mortgage rates are really at the highest level since 2007 right now. Mm-hmm. So we'll see how that goes. On Wednesday, ADP employment change for September. Ian will post at 8:15 a.m. Eastern Time. And this survey predicts this reading will show U.S. private companies may have added 200,000 jobs in September, which is greater than 132,000 payrolls added in August. And on Friday, we have the jobs report, which we've already covered. So be on lookout for that for 8:30 a.m. on Friday.
And remember, weaker is better. Bad news is good news in this market.
I know it's not, we have to get our minds to do a shift there and think.
Yeah. So remember last month with that jobs report, it came out stronger than expected. It tipped off the sell up in the market.
Right.
So I think a lot of investors are going to be braced for perhaps a higher number, which means that if it does come in lower, you'll see a rally.
There you go. Right from Ian's mouth to our ears. So Ian, we actually have in our comment section for today's talk, Antonio wrote and posted, this has been a rocky road with many more obstacles to come. I am prepared and ready for this journey. I would like for Amber and Ian to know you both are very much appreciated for keeping us leveled through this time of uncertainty. It's a very nice comment from Antonio.
Oh, thank you. It was nice of you.
Thank you, Antonio.
And it has been a rocky road.
Yeah, certainly.
You know, a lot of people make absolute fortunes investing in tech and growth stocks. And most people say, you just got lucky. But when you're in these bear markets, you realize it's not so much luck. It really is, do you have the wherewithal and are you positioned correctly to be able to survive this type of volatility? Because it's not easy. And, like we always say, Antonio, growth should be one part of your portfolio, but make sure that you are properly diversified into bonds and fixed income and value and preferred stocks, and then have your speculative investments in your growth holdings, which is pretty much what we cover.
Good point, Ian. Excellent point. We have a question from Linda C. Linda's a loyal watcher, and Linda would like to know, what are your thoughts on Upwork, Ian? You have any thoughts on that particular stock?
That's a great question. So Upwork was one of these momentum darlings during the last couple of years. It's obviously fallen out of favor with the markets. For those of you who don't know, Upwork allows you to hire anyone around the world. So if you're looking for somebody to develop a website for you, or maybe just do a little graphic design, you can hire somebody for a more cost effective price in India or South America. The stock, the other competitor in that space is Fiverr, which specializes more in designs, whereas Upwork, you can get a little more technical. I think if you look at the revenue growth in this stock, the revenues in the last quarter grew about 30% year-over-year growth. They're not showing positive earnings. However, the stock is like a $1.3 billion market cap. They're earning, and it's trading sometimes like something like 3 or 4 times revenues, which is pretty cheap for software companies. We used to value some of these software and cloud companies at like 10 times, and sometimes they went 20 times during the Momo days of 2 years ago. So it's getting to a place right now where it looks really attractive. The key is whether or not this company can start earning some money in the future. And, we haven't seen it yet. And in this market that we're in, the companies that aren't earning money today are getting, the most punished of anything else. If you're not free cash flow positive and you're not showing positive earnings, the as interest rates go up, it's basically sucking value out of your stock in a way that is opposite of what we saw in the past, whereas interest rates were going down, it was pushing value into these stocks. I think that we're starting to shift. Like, I think the 2-year has peaked. I think even though the Fed talks tough about being 4.5% to 5% next year, I think the economy is going to slow enough that they're not going to go that far. And what that's going to cause is a reversal of this trade where you saw money coming out of the high growth stocks into fixed income and into US dollars. I think you're going to see it actually go out, almost like a tide going out and back into these growth stocks. So, I mean, I've never been bullish on Upwork per se. I know it's in one of the legacy portfolios we added, but I actually am bullish on the stock down here because I think the valuation has come down to something that is really attractive. And also, it solves a huge problem. It's hard to find good developers to start a business or a new enterprise in a cost-effective way. Here, you can do it by hiring somebody anywhere in the world that can do the same work. And I've actually used Upwork myself. So, I'm intimately familiar with the company. I've hired a few people to work on other projects for me via Upwork, and also Fiverr, which hasn't come down as much as Upwork, by the way.
Okay, well, that's good to hear. Thank you for your insights, Sir Ian, and thank you to Antonio G and Linda C for writing in. We appreciate you so much. And anyone watching, know that you can post a question in the YouTube comments section of this video, or email us at winninginvestordaily@bannionhill.com with your questions, and we'll be sure to get to them. So, Ian, I thought we'd move on to Megatrend news for this
Right.
week. It's always interesting. So Tesla's AI Day took place this past Friday, their AI Day of 2022. And at the event, it's all the buzz this past weekend, but the tech company unveiled its Tesla bot, Optimus. Yeah. Did you get a chance to see the bot in action?
I did, actually. I think they're priced at like $20,000, right?
They are.
It's like for those of you that haven't seen it yet, maybe we can show a clip, but it's like Rosie from the Jetsons.
Yes, well, I love Rosie, so some of the don't we all? Yeah. Well, Elon Musk said that it was the first time it was working, this robot, without any, quote, support cranes or mechanical mechanisms or cables, end quote. And he later added that, quote, right now, we just want to make basic humanoid work well. And our goal is the fastest path to useful humanoid robot possible. And I can add, as I was reading through the news on this, one commenter on TechCrunch.com noted, quote, you may want to, if you want to go to Mars and build a colony, you will do so with an army of robots. Hopefully that's not lost on anyone. So it's definitely not, in my opinion, Ian. I believe it's just the beginning where we see more.
Yeah, I would say one thing, like if you look at Tesla's robot, but then you also compare it to what Boston Dynamics has done.
Oh, yes.
I mean, there are companies that are way ahead of what Tesla just unveiled. Scary almost, if you think about, what they could possibly use these robots for in the future. But that I don't think that what Tesla showed us was like the pinnacle of where we are in the robotics age.
It's just the beginning for what they're working on, especially in AI tech. But Tesla is a really just a very diversified company. It's more than an EV company, as you can see, is in AI, it's in robotics, it's in solar. And just speaking about Tesla, we actually currently hold Tesla, the stock itself, in our model portfolio, in our legacy portfolio. It's been in the portfolio since around October of 2018. We have an open gain right now of over 1,000%. So to learn more about Ian's investment recommendations, if you like, and how you can get started following his research that really focuses on tomorrow's biggest investment trends today, well, please click the bull icon right here over my shoulder to get started. So that was interesting Tesla news. Tesla always makes headlines.
Yeah. And, I think about tech and how we're solving some of the world's biggest problems. And I just, there's so much negative news in the media. Like, you turn on any cable channel and they'll just tell you all the terrible things are happening. Humans are awesome. I mean, Amber, so there was a robotic NASA spacecraft this weekend. I don't know if you saw DART.
Okay.
Actually last week.
Mm-hmm.
And it hit an asteroid that was moving at 14,000 miles per hour. That was millions of miles away from Earth.
Right.
Just to prove that if we ever have this problem of asteroids coming to Earth, we can save ourselves by shooting satellites into it. I think that was so incredible. It just shows you, what we're actually capable of and some of the huge problems that we can solve. And, if we blow up enough asteroids, we're going to outlive the dinosaurs. So, I mean, that's a great thing, right?
Sure. That would be a great thing. We can last longer than we're expected to. Well, hey, if you have to defend ourselves, we defend ourselves.
Absolutely.
Well, and tech is certainly a way to that end there. So good point, Ian. So Ian, any more information to share for this week?
I think we covered a lot. There's a lot of economic data coming out. I think one thing that you have to be mindful of this week is some of the European manufacturing numbers that are coming out.
Mm-hmm.
The main reason is because, obviously there's been issues in Europe with Ukraine and Russia. And one of the main implications has been the energy costs have been going up in Europe significantly. Mm-hmm. And what that means is a lot of the manufacturing plants that, are in Germany primarily, are shutting down because it's actually, they lose money by producing some of the goods they were because the energy costs are so high. So, that's just something to be mindful about, that actually what's happening over the pond right now, whether it be in Europe or also, not in the Eurozone in Great Britain with what happened with the gilts last week and them actually going and doing QE again. Is just as important to our markets as what's happening here in the United States. So just be mindful of what's happening across the pond as an investor.
Very good point. Very good reminder. Thank you, Ian, for that. And thank you, everyone, for watching us this week. We appreciate you very, very much. And know that you can follow Ian and me on Twitter. Ian is at Invest with Ian, and I am at A Lancaster Guru. Please remember to give us a thumbs up on these videos if you find the content helpful, and also subscribe to our channel as it supports the channel. So that's it for this week, Ian. Thank you so much for sharing some time with all of us this morning. We appreciate your insights as always.
Oh, great to see you, Amber.
Great to see you too, Ian. Looking forward to seeing you next week. And please take care until then.